Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. Just a short video today on opening range, breakouts, initial balance, and understanding 3 levels of rise or fall. It's one of the things that I go much deeper into in the playbook, Best Trade Setups, which will be released hopefully no later than tonight, tomorrow, maybe Saturday at the latest. But understanding the opening range, Monday's the opening range. By the time Monday and Tuesday trade, we have what's called the initial balance. So in many cases, if you want to know more about that, you can read Toby Crable's Opening Range Breakouts books. You can just Google Toby Crable, C-R-A-B-E-L. But that establishes one of the extremes. Now, we had major red news on the calendar, and the only way that I will trade major red news is typically with the first bounce or the 3-peak reversal outside of the range, and that's after we've exceeded 3 levels of rise or fall. That can be, depending on the instrument, typically with currencies. 75 pips is my sort of average daily range that I look for with my day 2, so that's my strike zone area. But when we have our weekly range, I'm looking for 3 levels of rise or fall. When it, depending on what that range is, it can be 50, 50, and 50 for 150 pips. Now on a very, very large move, we might get 300 pips, which is 100, 100, and 100. Now we had CPI. So using that initial balance theory, Monday's the opening range. By the time Tuesday trades, in most cases, we have the higher low for the week established. We have one of the extremes will tend to hold over time in most instances, meaning that if we have a high or low of the week potentially locked in, that can help us develop a thesis for a larger 3-day setup. Now, we had major red news with CPI and the Fed on the calendar. Looking at the New Zealand dollar, you can go back and check any pair that you want. We'll run through a couple of examples. We had a Friday, Monday high-low, but Monday's range, when it went vertical after Tuesday traded, we had moved 149 pips from low to high. Now that's 3 levels of rise of 50, 50, and 50. That market then proceeded to go into consolidation as an inside day on day 3, and we had the Fed. The Fed broke structure on the inside with a vertical move down and then proceeded to pump back up into the high of the day. Now, again, I don't trade the news, but coming to the screen on day 4, we have a market now that if we have 3 levels of rise, and this is our upper third level, we've traded back up into the vertical move, the 100 pips now. We're in trading up into the upper third, trapping traders. The market breaks down and gives Europe-London traders a vertical capitulation blow-off move coming out of a pump and dump on day 4. So the point I'm emphasizing with this is everything is measured. Opening range, initial balance gives us our thesis for a larger 3-day move. If we can't trade those vertical moves, a lot of traders are trying to trade the vertical explosions, and then they miss the larger trade. This movement on the Fed day on Wednesday is just merely trapping volume, consolidating the volume for an explosive move later, which turns into a pump and dump for a capitulation. 149 pips, that's a 150 pip move. 3 levels of 50. The market, instead of trapping the volume in the upper third, drops down and consolidates the volume underneath of that third level, which is a 50 pip box, then breaks structure and pumps up into our 100 pip level to collapse and have a vertical capitulation trade in the Europe window. This is a scalable trade setup for a vertical capitulation back to the low of the week. High of the week, low of the week. We can look at the Aussie dollar, which of course will be very similar to New Zealand, but in terms of identifying which pair potentially may have been the better trade setup,
Possibly the Aussie dollar was a cleaner trade. It gave a nice short trade in the upper third, not only in the upper third, but in the upper quarter for a Asia sell-off and a Europe low-hanging fruit continuation vertical move. So again, everything is measured. This is a 150 pip plus movement, but there's our 150 level. They've exceeded that and then locked in that high. There's our little M top at 3 levels of rise. They've broken structure and then pulled it back up into that upper level. The Fed breaks it down and pumps back up for an Asian short trade and a Europe-London blow-off low-hanging fruit continuation trade. Traders have asked, well, how do you measure for gold and oil, all these other more volatile indexes? The only difference is that the range of movement is bigger. So in terms of gold, we have a 3-day setup. Friday formed our high for the beginning of the dump. Monday's our opening range. It's a Monday opening range breakout that pulls back inside on day 2 on our Tuesday, which is day 3 in that 3-day cycle. But more importantly, because we have CPI, the range of movement in the dump was 300 pips. The dump down is 3 levels of drop, 100, 100, and 100. They go vertical and go 471 pips. So 471 is essentially 500. So they've gone beyond 3 levels, 100, 100, 100. And what they're now doing is into the next 300 pip box. So they get into that next 300 pip box, except it fails in that last 100 pip box. They go 100, 100, and it fails in the last box before breaking down. And then, same as the other pairs, a narrow range inside day that breaks down on the Fed. So now we've broken back inside of our 300 pip box. And they pump it up into our 300 pip box. So again, just understanding we've exceeded 3 levels and they're now going into the next 3 levels. It fails, peak formation, they break down and they're pumping it up into the top of that level. Everything is measured for an Asian sell-off that breaks below the low of the day, the Fed pump up, pulls back, and there's our Europe-London low-hanging fruit trade right back to the beginning of the low of the week. So understanding that everything is measured. They go CPI. We have our first bounce that we can trade in that explosive movement. No setup for Fed on day 3. It's an inside day. They pump it back up into our 300 pip box. So understanding that measurement is allowing us a strike zone area to understand where we may potentially have a level for selling. They sell off in the Asian session on the pump and dump. It breaks down through the low of the day. They pump it up and resume. The trend trade is the low-hanging fruit continuation back to the low of the week. And as I said, I go into more detail in this in the playbook of best trade setups. But these little movements during the setup, especially on a Monday, opening range, that's establishing the high and low for the week. We're inside of a false break at the high of the week. Day 1, day 2, a day 3 vertical explosive move on CPI. But allowing retail, a lot of traders are trying to trade the explosive movement and gambling that they don't get a big spike or whatever. They think because they have a stop in place that will protect them. They could put a pin through this, and your closest fill price, at best, will usually not be less than 50 pips. They will pull the bids, and your execution fill on your stop loss will have massive slippage. And if you get lucky, it goes vertical. That's fantastic. But the easy trade is to trade the first bounce. It's safe. The news is done. We didn't get a setup on Fed, but we have an opening range, an initial balance. If we've exceeded that, it's broken back down inside. 3 levels of rise. They pump it back up to the top of that box, and we get a sell-off for 3 levels of fall on day 4 after the news. Opening range and initial balance. Study those traders. It will impact your thesis and your results every single week. Keep it simple. Still have a couple days left on the calendar. Lots of news today and tomorrow. Have a great day, and may the markets go with you.